Welcome back to the deep dive.
Hello.
Okay, so if you're trying to get your head around business finance, those financial documents, they can seem a bit much sometimes, right?
Definitely. Lots of numbers, lots of jargon.
Exactly. So today we're doing a deep dive into Part 3 financial documents, specifically from Unit 3 Business Finance.
And we're zooming in on Chapter 31, Ratio Analysis.
Right, and look, for you listening, maybe you're prepping for exams or you just want to get this stuff, our aim isn't really about memorizing formulas.
No, quite often those are actually provided for you.
The key thing, the really crucial bit, is understanding what each ratio is actually telling you. What does the number mean?
And how do you interpret it? Is it good? Bad?
Yeah.
Getting better? Worse?
And importantly, how do you compare? Compare this year to last year for the same company, or compare one company to another. That's the valuable skill here.
That understanding is really where the insight comes from. It helps you figure out how healthy a business actually is.
And just quickly, if you want more resources on this or other topics, do check out www.igcec-business.weebly.com.
Yeah, lots of good stuff there.
Okay, so let's start at the beginning. Ratio analysis. What is it, fundamentally?
Well, think of it like this. You've got these big financial statements, right? The statement of comprehensive income that tells you about profit over a period.
Income, expenses, profit, loss.
Exactly. And the statement of financial position, that's more like a snapshot. What the business owns, what it owes at a specific point in time.
Assets, liabilities.
Okay. So ratio analysis basically takes figures from those statements and uses maths, simple calculations really, to create ratios.
And these ratios help you draw conclusions about the business's performance, its financial position.
Precisely. They turn raw data into useful information, and we usually group them into different types. The main two we'll look at today are profitability ratios and liquidity ratios.
Okay, profitability. That sounds straightforward enough. Is the business making money?
Pretty much. Profitability ratios measure how well the business is performing in terms of making profit. So looking at profit relative to, say, its sales revenue or the money invested in it.
Got it. And the first big one here is usually gross profit margin.
Right. Gross profit margin. The calculation is gross profit divided by sales revenue, shown as a percentage.
And gross profit itself is just sales revenue minus the direct cost of making those sales, the cost of sales.
Exactly. So what this margin tells you is how profitable the core business activity is. Buying or making something and then selling it. How much is left from each pound or dollar of sales after paying for the goods themselves?
So a higher percentage generally means better trading. More efficient?
Generally, yes. It suggests they're maybe buying well or controlling production costs, or perhaps they have strong pricing power, but
it depends on the business type.
Hugely. Think about a supermarket versus, say, a designer furniture store. Very different business models, very different expected gross profit margins.
Right. A supermarket shifts lots of stuff quickly on maybe thinner margins.
Exactly. Our source mentions Ecoflomes, a builder. Their gross profit margin went up slightly, from 45.1% in 2015 to 46.8% in 2016.
Okay, so that little increase suggests their actual building projects became slightly more profitable year on year. Maybe materials got cheaper, or they managed projects better.
Could be either, or both. It points to an improvement in that core trading efficiency.
Okay, so that's gross profit. What about the next level down? Operating profit margin.
Ah, yes. This one takes the gross profit and then subtracts all the other day-to-day running costs, what we often call overheads.
So things like office salaries, rent, marketing, utility bills.
All of that. The calculation is operating profit divided by revenue, again, as a percentage.
So this isn't just about the cost of the product. It's about how well the business manages all its operational expenses compared to its revenue.
You've got it. It measures overall operational efficiency. A higher operating profit margin suggests the management is doing a good job controlling those overheads relative to the sales being generated.
And for Ecoflomes, their operating profit margin also went up from 17.4% to 19.5%.
Yeah, which is quite a healthy jump. It suggests that on top of the improved gross profit, they also got better at managing their general business expenses in 2016.
Interesting. So you can see how one might improve, but not the other, potentially?
Oh, absolutely. You could have rising gross profit, but if your overheads run wild, your operating profit margin could fall. These ratios tell different parts of the story.
Right. Now, the source also mentions markup. How does that fit in? It feels related but different.
It is related, often used more for pricing individual items. Markup is the profit per item as a percentage of the cost of that item.
Okay, wait. Gross profit margin was profit as a percentage of the selling price.
Exactly. Margin is based on revenue, markup is based on cost. That's the key difference.
So businesses use markup to work out the selling price from the cost.
Often, yes. It's a practical tool. Say something costs you $100. If you want a 50% markup, you add 50% of the cost, $50, to get a selling price of $150.
The Ecofilms example had a property costing US $200,000, and they made US $36,000 profit.
So the markup there is the $36K profit divided by the $200K cost times 100, which is 18%.
Got it. It's a cost plus pricing approach.
Essentially, yes.
Okay, moving back to the main statement ratios. Return on capital employed, ROCE. This sounds important. Like, how hard is the invested money working?
That's a great way to put it. ROCE is operating profit divided by capital employed as a percentage.
And capital employed is what exactly? All the money tied up long-term in the business.
Pretty much. It's usually the owner's investment, the equity, plus any long-term debt like bank loans. It represents the total pool of long-term funds the business is using.
So ROCE compares the profit generated from operations to the total pot of money used to generate that profit.
Precisely. It's a fundamental measure of how efficiently the business is using its long-term funding to make a return. Higher ROCE is generally better, more profit bang for your buck, so to speak.
And Ecofilms, how do they do?
They saw a really good improvement, from 17.8% in 2015 up to 23% in 2016.
That's quite a significant jump. Suggests they got much better at generating profit from the overall investment in the business.
It does, and you'd often compare that ROCE figure to, say, what you could earn by just putting the money in a bank, or the interest rate the company pays on its loans. If your ROCE is lower than your borrowing costs, that's a serious problem.
Right, you're losing money on your investments effectively.
Mm-hmm.
Okay, so that covers the main profitability angles, but being profitable isn't the whole picture, is it? You mentioned liquidity.
Absolutely critical. Profitability is great, but liquidity is about survival day to day. Liquidity is about cash.
How easily can the business turn its assets into actual cash?
Exactly. Cash itself is perfectly liquid, obviously. Then you have things like money owed by customers' trade receivables, which should become cash fairly soon.
And inventory, the stock.
That's usually considered less liquid. You have to find a buyer, make the sale, then maybe wait to get paid. It takes time.
Compared to non-current assets like buildings or machinery, which are much harder to turn into cash quickly without disrupting things.
Right. So current assets are the focus for liquidity cash, receivables, inventory, things expected to become cash within roughly a year.
And why is this so vital?
Because businesses have bills to pay now. Short-term debts or current liabilities, wages, suppliers, tax payments.
Things that need paying soon.
Yes. And if a business doesn't have enough liquid resources, enough cash, or things that can quickly turn into cash to pay those bills when they're due, it's in trouble.
Even if it's profitable on paper.
Especially then. It's called overtrading sometimes. Growing fast, making profit, but running out of cash to fund it all. It can lead to collapse. Profit is one thing, cash flow is another.
So liquidity is about managing that short-term cash flow need. How do we measure it?
Two main ratios. The first is the current ratio.
Okay. How's that calculated?
Simple. Current assets divided by current liabilities.
And it tells us.
It gives a general idea of whether the business has enough current assets floating around to cover its short-term debts. Kind of a safety buffer measure.
The source mentioned a range, like 1.5 to 2, being generally okay.
Yes, that's a common benchmark, though it varies by industry. It means for every £1 or $1 of debt due soon, the business has £1.50 or $2 of current assets potentially available.
And Ecofilms had 1.53 and 1.56 in those 2 years.
Which falls right in that suggested healthy range. It implies they probably had enough current resources to meet their obligations.
But hang on, could it be too high? Like, what if it was 4?
Good point. Yes, a very high current ratio might actually be inefficient. It could mean too much cash sitting idle, not being invested.
Or maybe too much money tied up in inventory that isn't selling. Or customers taking ages to pay.
Exactly. It could signal poor management of working capital. So, like many ratios, there's often a sweet spot, not just higher is better.
Okay, that makes sense. What's the second liquidity ratio, the tougher one?
The acid test ratio, sometimes called the quick ratio.
Acid test?
Yeah.
It sounds harsh.
It is a harsher test. The calculation is current assets minus inventory, then divided by current liabilities.
So you take inventory out of the equation before comparing to liabilities. Why?
Because, as we said, inventory is the least liquid current asset. You can't guarantee you can sell it quickly or for the price you expect. The acid test asks, If we had to pay all our short-term bills right now, could we do it using only our cash and the money customers owe us without relying on selling stock?
It's a real crunch time test then.
It is. A ratio of 1 here means your quick assets exactly match your current liabilities. Below 1 suggests you'd need to sell inventory or find other cash quickly to cover everything.
Ecoflows went from 0.88 in 2015 to 1.00 in 2016.
So in 2015, their quick assets didn't quite cover immediate debts. They were relying partly on inventory sales. But by 2016, they improved to the point where quick assets match current liabilities. That's a stronger position.
And again, this would vary massively between, say, a supermarket holding lots of stock and a software company with almost none.
Absolutely. A supermarket might operate quite happily with an acid test below 1 because its stock turns over very quickly and reliably. A software firm might have a very high ratio. Industry context is vital for interpreting this one.
Okay, so we've got these individual ratios for profitability and liquidity, but you said at the start, the real power comes from comparing them.
Yes, absolutely. A single ratio number doesn't tell you much on its own. Context is everything.
So first way to compare is over time for the same business.
Crucial. Look at the ratios for a company over, say, 3, 5, 10 years. Are things getting better? Worse? Staying stable?
Like with Ecoflows, we saw their gross profit margin, operating profit margin, ROCE, and acid test all improving from 2015 to 2016.
Exactly. That pattern tells a consistent story of improved performance and financial health over that year. If they were all declining, that would be a major warning sign. Trend analysis is key.
And the other way is comparing different businesses, like competitors.
Yes, comparing with similar businesses in the same industry gives you a sense of relative performance. Are you doing better or worse than your rivals?
The source used Ford and Honda's ROCE in 2015. Ford had 17.8%. Honda had 9.7%.
Yeah. On the surface, Ford looks like it was using its capital much more effectively that year.
But you need to be careful just comparing one number, right?
Absolutely. Maybe Honda was investing heavily in new tech that year, depressing short-term profits but setting up future growth. Maybe their capital structures were different. You can't just look at one ratio and declare a winner.
It's more like using the ratios as clues to dig deeper and ask why the numbers are different.
Exactly that. They are diagnostic tools, not definitive answers. They guide your analysis. And while big companies live and breathe this stuff,
smaller businesses can use them too, to track their own progress.
Definitely. Even calculating a few key ratios regularly can give a small business owner valuable insights into their own performance trends.
Okay, let's test that understanding a bit. Listener, think about this. If a company's gross profit margin jumps up nicely one year, what part of their business is probably improved?
Remember what gross profit focuses on.
And another one. You have two companies, similar industry, both have a current ratio of, say, 1.8, good, but company A's acid test ratio is 1.5, while company B's is only 0.7. What does that difference tell you about how they manage their current assets, particularly one specific type?
Think about what the acid test takes out.
Yeah, working through those helps cement what these ratios actually mean in practice.
It's all about that interpretation.
Right, well, that pretty much wraps up our deep dive on ratio analysis for today.
We've covered those key profitability ratios, gross profit margin, operating profit margin, a quick look at markup, and the important ROCE.
And then the vital liquidity ratios, the current ratio, and the stricter acid test ratio.
And hopefully hammered home that calculating them is just step 1. Understanding what they mean, and especially comparing them over time or against peers, is where the real value lies.
It's like learning to read the story the numbers are telling about a business's health and performance.
Couldn't have put it better myself.
So a final thought for you to mull over. Knowing these basic financial health checks, how might that be useful for you personally down the line? Maybe when you're looking at companies to invest in someday.
Or even just evaluating a potential employer. Understanding their financial stability could be pretty useful, couldn't it?
It's a practical skill. And don't forget, for more materials and support, you can always visit www.igces-business.weebly.com.
Definitely worth checking out. Hope this session helped clear things up.
Thanks for joining us on The Deep Dive.